Before we begin, please note that the information provided in this video is for educational and informational purposes only. It is not intended to be, and should not be construed as financial, legal, or investment advice. You should consult with a qualified professional before making any financial decisions. What if I told you that nearly every single mortgage rate forecast you've read in the last 2 years has been spectacularly wrong? I'm not talking about slightly off. I'm talking about predicting a sunny day during a Category 5 hurricane wrong. Major banks, the National Association of Realtors, the Mortgage Bankers Association, the very institutions we're told to trust, they all predicted rates would fall significantly. Instead, they skyrocketed, crushing the dreams of millions of potential homebuyers who were told to just wait it out. Maybe that was you. You found the perfect house. You could picture your life there. But you saw a headline that said, "Rates expected to drop by year end." So you waited. And you watched as that dream home's monthly payment ballooned by $500, then $1,000, then $1,500 a month, pushing it forever out of reach. That feeling of helplessness of being misled by the experts is exactly why this video exists. We are not going to give you another bogus prediction. We are going to give you the playbook. We're going to pull back the curtain and show you step by step how these forecasts are actually made. You'll learn what data the pros are looking at, what their models get right, and more importantly, where they consistently go wrong. By the end of this journey, you won't need to hang on every word of a so-called guru. You will understand the fundamental forces that actually move mortgage rates, the economic signals, the market psychology, and the one key indicator that is the closest thing we have to a crystal ball. This is about trading anxiety for knowledge and confusion for confidence. It's about empowering you to make the single biggest financial decision of your life, on your terms, with your own understanding. So let's start with the most important question. Why are we so obsessed with these forecasts in the first place? It's human nature. Buying a home is terrifying. It's an ocean of money, and nobody wants to feel like they jumped in at the worst possible moment. We crave certainty in a process that is filled with uncertainty. We want someone in a suit to look into a camera and tell us, "Now is the right time," or "Wait 6 months and you'll save a fortune." These forecasts are selling a product, and that product is confidence. It's a sense of control. The problem is, it's an illusion. The people making these predictions are not charlatans. They are brilliant economists at places like Fannie Mae, Freddie Mac, major investment banks, and housing associations. They use incredibly complex econometric models, factoring in dozens of variables to project the future. But here's the secret. All of those complex models are essentially trying to predict the path of one single thing. If you understand this one thing, you understand the heart of the mortgage market. It's not the Federal Reserve's interest rate. That is the single biggest misconception in all of finance, and it has cost people fortunes. The Fed controls the short-term federal funds rate, which is the rate banks charge each other for overnight loans. This directly impacts things like credit card rates, auto loans, and home equity lines of credit. But it does not directly set 30-year fixed mortgage rates. The real driver, the sun that the entire mortgage solar system revolves around, is the yield on the U.S. 10-year Treasury bond. That's it. That's the secret. If you want to know where 30-year mortgage rates are going, stop watching the Fed chairman and start watching the 10-year Treasury yield. Look at a chart. Lay the 30-year mortgage rate over the 10-year Treasury yield for the last 50 years. They are practically dance partners. They move in near perfect sync. When the 10-year yield goes up, mortgage rates go up. When it goes down, mortgage rates go down. So why? Why are these two so inextricably linked? To understand this, you need to think like a giant institutional investor, a pension fund, or an insurance company with billions of dollars to park somewhere safe. You have two main options for a safe long-term investment. Option A is the 10-year Treasury bond. This is considered the safest investment on planet Earth. It's a loan you make to the U.S. government, and they promise to pay you back with interest over 10 years. The yield is simply the annual return you get on that investment. Because it's backed by the full faith and credit of the United States government, the risk of not getting paid back is virtually zero. Option B is something called a mortgage-backed security, or MBS. This sounds complicated, but the concept is simple. Your bank doesn't just hold on to your mortgage for 30 years. They bundle it together with thousands of other mortgages and sell that bundle as a bond to those giant investors. The investors then collect the monthly mortgage payments from all those homeowners. Now, put yourself back in that investor's shoes. You can buy the ridiculously safe U.S. Treasury bond, or you can buy the MBS. The MBS is also very safe, but there's a little more risk. What if some homeowners default on their loans? What if they pay off their mortgages early by refinancing, and you stop getting those interest payments? To convince you, the investor, to take on that tiny extra bit of risk, the MBS has to offer you a better return, a higher yield than the 10-year Treasury. That extra bit of yield is called the spread. Historically, the interest rate on a 30-year mortgage has been, on average, about 1.7 percentage points, or 170 basis points, higher than the yield on the 10-year Treasury. And that right there is the entire mechanism. The 10-year Treasury yield sets the base level, risk-free rate for long-term money. Mortgage rates then just add their spread on top of that. So, if the 10-year Treasury yield is 4%, you can expect mortgage rates to be floating somewhere around 5.7%. If the 10-year yield suddenly spikes to 4.5%, you can bet your bottom dollar that mortgage rates will be heading towards 6.2% almost immediately. This is why the expert forecasts go so wrong. Their complex models aren't really forecasting mortgage rates. They're forecasting the 10-year Treasury yield, and that is one of the most difficult things to predict in all of finance. It's a global auction that happens every single second of every single day, and its price is influenced by everything from inflation data in the US to manufacturing numbers in China to geopolitical conflict in the Middle East. So, if we know that the 10-year Treasury is the key, the billion-dollar question becomes, what moves the 10-year Treasury? The answer is a handful of powerful forces. Forces that, once you understand them, will allow you to see the market with a clarity you never thought possible. You'll be able to read the headlines and instantly know if they are likely to push rates up or down. The most powerful of these forces, the one that has completely dominated the narrative and shattered every forecast for the past few years, is inflation. The relationship between inflation and the 10-year Treasury is the bedrock of all rate prediction. Understanding that connection is the first and most critical key to unlocking this entire puzzle. It dictates the actions of the Federal Reserve, it shapes investor psychology, and it holds the power to make or break your home buying dreams. And it's exactly where we're going next. It's the reason your grocery bill feels like a gut punch compared to just a few years ago. It's why that tank of gas costs what a fancy dinner used to. It's that invisible thief that sneaks into your bank account and silently steals the value of your dollar, even while you sleep. This force, this economic monster under the bed, is inflation. And understanding it isn't just an academic exercise. It is the absolute cornerstone of predicting where mortgage rates are headed. At its core, inflation is deceptively simple. It's the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of currency is falling. Think of it like this: if you have $100 and inflation is running at 10% a year in 1 year, that same $100 bill will only buy you what $90 would have bought you today. Your money is losing its strength. But why does this happen? The classic explanation is too much money chasing too few goods. Imagine a small island with 10 people and only 10 coconuts. Each coconut is worth $1. Simple. Now imagine a helicopter flies over and drops $1,000 onto the island. Suddenly everyone is rich. But there are still only 10 coconuts. What happens to the price of a coconut? It skyrockets. The coconuts didn't become more valuable. The money became less valuable. That, in a nutshell, is the danger of an overheating economy and the essence of inflation. Now, in the United States, we have a group of economic superheroes, or to some, supervillains, tasked with fighting this exact monster. They are the Federal Reserve, often just called the Federal. The Fed is the central bank of the United States, and Congress has given it a dual mandate, two primary missions that are often in conflict: to achieve maximum employment and to maintain stable prices. Stable prices is just a fancy way of saying keep inflation under control. Because if inflation runs wild, it destabilizes the entire economy. It erodes savings, creates uncertainty for businesses, and disproportionately hurts those on fixed incomes. It's a cancer on the economic body. So, how does the Fed fight this inflation dragon? They have one primary weapon, a tool so powerful it can steer the entire US economy. It's called the federal funds rate. Now, stay with me because this sounds complicated, but the concept is crucial. The federal funds rate is the interest rate that banks charge each other for overnight loans to meet their reserve requirements. Think of it as the wholesale cost of money for the banks themselves. But what you really need to know is this. The federal funds rate is the foundational interest rate for the entire economy. It's like the headwaters of a giant river. When the Fed raises or lowers the water level at the source, it eventually changes the water level for every single tributary downstream. That means your credit card rates, your car loan rates, and yes, indirectly, your mortgage rate. When the Fed sees inflation getting too high, When the economy is overheating, they do something called tightening monetary policy. They raise the federal funds rate. This makes it more expensive for banks to borrow money. And what do banks do when their costs go up? They pass those costs on to you, the consumer. Borrowing becomes more expensive for everyone. The idea is to slow down spending to cool off the economy, to reduce the amount of money chasing those same goods and services, and thus bring inflation back down. It's like tapping the brakes on a speeding car. Conversely, if the economy is weak and there's a risk of a recession, the Fed will loosen policy by cutting the federal funds rate. This makes borrowing cheaper, encouraging businesses to invest and consumers to spend, effectively hitting the gas to stimulate economic growth. So, the first and most fundamental link is this: high inflation forces the Fed to raise rates. Low inflation or a weak economy allows the Fed to cut rates. This is the central drama that every mortgage rate forecaster watches with bated breath. But this begs the question: how does the Fed even know what inflation is? They can't just look at the price of milk. They need a systematic way to measure it. And for that, they rely on two key reports. The first is the one you hear about most on the news, the CPI, or the Consumer Price Index. The CPI is calculated by the Bureau of Labor Statistics. Imagine they create a basket of goods and services that represents what a typical urban American family buys in a month. This basket includes everything from eggs and gasoline to rent, haircuts, and airline tickets. Every month they go out and measure the total cost of this exact same basket. The percentage change in the cost of that basket from one year to the next is the CPI inflation rate. When you hear about the headline CPI, that includes everything in the basket. But you'll also hear about core CPI. Core CPI is the same basket, but it excludes the two most volatile categories, food and energy. Why? Because the price of gas can swing wildly due to a war overseas, and the price of lettuce can spike due to a drought, things the Federal Reserve has no control over. By looking at core inflation, the Fed tries to get a clearer picture of the underlying stickier inflation trend in the economy. But here's an insider tip. While the media loves to talk about the CPI, the Fed has a preferred inflation gauge. It's called the PCE Price Index, or the Personal Consumption Expenditures Price Index. The PCE is a bit broader than the CPI, and crucially, it adjusts for consumer behavior. For example, if the price of beef skyrockets, the CPI basket is slow to change. But the PCE model recognizes that people will likely substitute cheaper chicken for expensive beef, and it captures that change. Because of this, the Fed believes the PCE, and specifically core PCE, is a more accurate and less volatile indicator of long-term inflation. So the Fed has its mission, stable prices. It has its weapon, the federal funds rate. And it has its dashboard, the CPI and PCE reports. But what is it aiming for? What is the magic number? The Fed's official target for inflation is 2%. Not 0 but 2%. This surprises a lot of people. Why would they want prices to go up at all? There are two main reasons. First, a little bit of steady, predictable inflation encourages people and businesses to spend and invest rather than hoard cash. If you know your money will be worth slightly less next year, you have an incentive to put it to productive use today. Second, and more importantly, it gives the Fed a buffer against the ultimate economic evil, deflation. Deflation is when prices are consistently falling. It sounds great, right? Everything gets cheaper. But it is an economic death spiral. If you know a car or a TV will be cheaper next month, you'll wait to buy it. And if everyone waits, spending grinds to a halt, companies lay off workers, and the economy collapses. A 2% inflation target keeps us a safe distance away from that deflationary cliff, while also giving the Fed room to cut interest rates in a recession without pushing them into negative territory. So now we have the full picture of the first key driver. We know that the Fed is constantly watching inflation data like a hawk. We know they're looking at CPI and especially PCE. We know their goal is to get inflation back down to 2%. And we know their primary tool for doing this is raising or lowering the federal funds rate, which sets the foundation for all other borrowing costs. Therefore, the most basic level of mortgage rate forecasting begins with a simple question: where is inflation today and where is it likely to go? If you see reports showing inflation is high and stubborn, you can bet the Fed will be talking tough, keeping rates high, or even raising them further. If you see inflation falling rapidly, you can expect the chatter to shift towards potential rate cuts. But here's the critical twist, the thing that separates a basic understanding from a truly deep one. The Fed's actions are only half the story. The anticipation of the Fed's actions is the other half, And in many ways, it's even more powerful. The market doesn't wait for the Fed to actually move rates. It tries to guess what the Fed will do 6 months or even a year from now. This guessing game, this high-stakes poker match between investors and the central bank, is played out every single day in the bond market. And the bond market is the true arena where mortgage rates are born. It's where cold, hard data about inflation collides with human emotion, fear, and greed. It's a global auction that determines the price of money itself. And that's where our journey takes us next. To understand this arena, you first need to forget about the stock market. Forget the flashy tickers and the bell ringing on Wall Street. The real power, the quiet, immense gravity that bends the financial universe, is in the bond market. And at its center is the single most important financial instrument on the planet, the U.S. Treasury bond. So what is a bond? In the simplest terms, it's an IOU. When you buy a U.S. Treasury bond, you are lending money to the United States government. That's it. You give them your money, say $1,000, and they promise to pay you back in a set number of years. Along the way, as a thank you for the loan, they pay you a small fixed amount of interest every year. This interest payment is called a coupon. At the end of the term, whether it's 2 years, 10 years, or 30 years, you get your original $1,000 back. It's considered the safest investment in the world because it's backed by the full faith and credit of the U.S. government, which has the power to tax and print money to pay its debts. Now, there are many types of these government IOUs, but for mortgage rates, there is one that is king, the 10-year Treasury note. Think of the 10-year Treasury as the North Star for almost all long-term lending in America. Its performance is the baseline, the fundamental rhythm against which other, more complex loans are measured. When you hear financial news anchors talk about the bond market, they are almost always referring to the price and interest rate of the 10-year Treasury. It is the financial world's heartbeat. But here's the critical part, the concept that, once you grasp it, will unlock your understanding of how all of this works. While the interest payment, the coupon, on a bond is fixed when it's first issued, the bond itself can be bought and sold on the open market just like a stock. And its price fluctuates every single second. This creates a fascinating and powerful dynamic. Imagine a simple seesaw. On one end, you have the price of a bond. On the other end, you have its yield. The yield is the actual return you get on your investment if you buy the bond on the open market today. These two things, price and yield, have an inverse relationship. They are permanently locked on opposite ends of that seesaw. When the bond's price goes up, its yield goes down. When the bond's price goes down, its yield goes up. Let's make this real. Imagine the government issues a new 10-year Treasury bond for $1,000 with a 4% coupon. That means it pays $40 a year in interest. Simple enough. But now let's say there's a huge economic scare. A global crisis hits. Investors everywhere panic. They don't want risky stocks anymore. They want safety. They want the ironclad guarantee of a U.S. Treasury bond. So a massive wave of money floods into the bond market. Everyone is trying to buy that safe haven bond. What happens when demand for something skyrockets? Its price goes up. So now, that $1,000 bond might be selling for $1,100 on the open market. But here's the key. The government is still only paying that fixed $40 a year in interest. The coupon doesn't change. So, if you are the person who buys that bond for $1,100, you're still only getting $40 a year. Your effective rate of return, your yield, is now much lower. It's 40 divided by 1,100, which is about 3.6%. The price went up and the yield went down. The seesaw tilted. Now let's flip it. Imagine the economy is booming. Everyone is optimistic. People are pulling their money out of safe, boring bonds and pouring it into the stock market, hoping for bigger returns. The demand for bonds plummets. To sell their bonds, investors have to lower the price. That same $1,000 bond might now only sell for $900, but it still pays that same $40 a year. If you buy it for $900, your yield is now 40 divided by 900, which is about 4.4%. The price went down and the yield went up. The seesaw tilted the other way. This seesaw is moving constantly, pushed and pulled by the collective hopes and fears of millions of investors around the world. Every piece of economic news, an inflation report, a jobs number, a conflict overseas, causes traders to either rush toward the safety of bonds or flee from them in search of higher returns. The yield on the 10-year Treasury is, therefore, a real-time global referendum on the health and future of the economy. A falling yield suggests fear and an expectation of slower growth. A rising yield suggests confidence, but also a fear of inflation. So, what on earth does this global seesaw have to do with your mortgage payment? Everything. Mortgage lenders are in the business of risk. When they lend you hundreds of thousands of dollars for 30 years, they are taking a significant gamble. You might lose your job, the home's value could fall, or you might prepay the loan early. To decide what interest rate to charge you, they need a starting point, a baseline risk-free rate. And what better baseline than the yield on the 10-year Treasury? A lender thinks, if I can get, say, a 4% return guaranteed by lending money to the US government for 10 years, then to lend money to an individual for 30 years, a much riskier proposition, I need to charge a whole lot more than that. That whole lot more is called the spread. Mortgage rates are essentially the 10-year Treasury yield plus a spread. This spread accounts for the lender's operational costs, their profit margin, and most importantly, the risk of lending to you instead of the government. While the spread itself can widen or narrow based on factors in the housing market, the primary driver of your mortgage rate is the underlying Treasury yield. They are like two dancers tethered together. They don't move in perfect lockstep, but when one moves, the other is sure to follow. If you watch a chart of the 10-year Treasury yield and a chart of the average 30-year fixed mortgage rate, you'll see they trace almost the exact same path. When bond traders around the world get scared and pile into treasuries, pushing yields down, mortgage rates follow them down. When they get optimistic and sell bonds, pushing yields up, mortgage rates follow them up. This is why your ability to afford a home in Ohio is directly impacted by the investment decisions of a pension fund manager in Tokyo or a central banker in Frankfurt. They are all trading in this massive interconnected market, collectively pushing that seesaw up and down. Their combined actions create the foundational rate upon which your mortgage is built. The bond market is the invisible force field that sets the price of money for decades to come. So we have this massive global machine, a worldwide sentiment meter, setting the baseline rate. But there's one player with a hand so heavy, it can tilt the entire seesaw on its own. A single institution that can make or break the bond market with just a few chosen words, or by deciding to become the biggest buyer or seller in the entire arena. That institution is the Federal Reserve. And their game, a high-stakes strategy of subtle signals and brute force, is what we need to understand next. To understand the Federal Reserve, you have to stop thinking of it as a building in Washington, D.C., and start thinking of it as a small group of people playing the most influential game on Earth. Their playing field is the entire U.S. economy, and their goal is to keep it balanced on a knife's edge. They have two primary tools to do this: a surgeon's scalpel and a sledgehammer. The scalpel is their communication, their subtle signals. The sledgehammer, that's their brute force. Let's start with the scalpel. 8 times a year, a council of 12 economic decision-makers, known as the Federal Open Market Committee, or FOMC, meets behind closed doors. For 2 days they debate, they argue, and they analyze a flood of data. Then they emerge and make a statement that can cause global markets to swing by trillions of dollars. Their primary announcement is about one thing: the federal funds rate. Now, the federal funds rate is not your mortgage rate. It's not your credit card rate. It's the interest rate at which big banks lend to each other overnight. Think of it as the foundational bedrock cost of money in the entire financial system. It's like the tuning fork for an entire orchestra. If the Fed raises this rate, the pitch of every other loan in the economy tends to rise with it. If they lower it, the pitch falls. So when a mortgage rate forecaster is trying to figure out where rates are headed, their first question is always, what will the Fed do with that tuning fork? And to figure that out, they become professional code breakers. They don't just read the FOMC's press release. They dissect it. They analyze every verb, every adjective. Did the Fed say they would be patient before raising rates? Or did they remove the word patient? That one word change is a signal worth billions, a flare sent up into the night sky for all of Wall Street to see. They analyze the Fed chair's press conference, not just for what is said, but how it's said. The tone of voice, the slight hesitation before an answer. They're reading economic tea leaves, searching for any clue about the future. And then there's the most fascinating signal of all, a strange-looking chart called the dot plot. This is where each of the Fed governors and presidents anonymously places on a graph showing where they personally believe the federal funds rate will be in the coming years. It's a rare, semi-transparent glimpse into the collective mind of the council. It's not a promise, it's not a guarantee, but it's the Fed's own forecast of its future actions. For a mortgage forecaster, the dot plot is gold. It tells them the general direction and speed the Fed wants to travel. Is the cluster of dots moving higher, signaling rate hikes? Are they flat, signaling a pause? Or are they moving down? This chart is the closest thing we have to a roadmap of the Fed's intentions. This entire process, the carefully worded statements, the press conferences, the dot plot. This is the Fed's game of subtle signals. It's their attempt to guide the massive, chaotic, trillion-dollar market with whispers and nudges. They hope that by simply signaling their intent, the market will do the work for them. Investors will see the signals and start buying or selling bonds accordingly, pushing interest rates in the direction the Fed wants them to go, all without the Fed having to do much at all. But sometimes whispers aren't enough. Sometimes the economy is in such a crisis that the surgeon's scalpel is useless. That's when the Fed picks up the sledgehammer. This brings us to the brute force. To understand this, we have to go back to the 2008 financial crisis. The economy was in a free fall. The Fed had already used its main tool. They had cut the federal funds rate all the way down to zero. The tuning fork was on the floor. But the orchestra was still playing a funeral march. They needed something bigger, something more direct. So they unleashed a radical policy known as quantitative easing, or QE. If the Fed funds rate is a subtle influence, QE is a direct, overwhelming intervention. Here's how it works. The Federal Reserve, which has the unique ability to create money out of thin air, started printing it. Digitally, of course. We're talking hundreds of billions and eventually trillions of dollars. And then they used that newly created money to go on the biggest shopping spree in human history. And what were they buying? They were buying the very assets that underpin your mortgage rate, U.S. Treasury bonds, and, most importantly, mortgage-backed securities, or MBS. Remember how the bond market works. It's all about supply and demand. By storming into the market and buying up these bonds and MBS with an unlimited checkbook, the Fed created an immense artificial wave of demand. It was like a whale jumping into a swimming pool. This massive demand pushed the prices of these bonds and MBS way up. And what happens when a bond's price goes up? Its yield goes down. And that was the whole point. By directly forcing down the yields on Treasury bonds and mortgage-backed securities, the Fed was able to physically drag mortgage rates down to historic lows, even when their main policy rate was already at zero. It wasn't a suggestion. It wasn't a signal. It was brute force. They were no longer just the conductor of the orchestra. They had jumped into the violin section and were physically pushing the players' arms to make the music they wanted. For years, the Fed's balance sheet swelled. From less than $1 trillion to nearly $9 trillion. They became the single biggest player in the bond market. And for mortgage forecasters, a new critical question emerged. What is the whale doing? Is it still buying? Is it holding steady? Or is it about to get out of the pool? Because the opposite of QE is just as powerful. It's called quantitative tightening, or QT. This is when the Fed stops buying new bonds and lets its old bonds mature, effectively removing that money from the system. Or, in a more aggressive move, they could even start actively selling the bonds they own. What does this do? It's the whale getting out of the pool. That massive, artificial source of demand vanishes. With less demand for Treasury bonds and mortgage-backed securities, their prices fall. And when their prices fall, their yields and the mortgage rates that are tied to them go up. So, a modern mortgage rate forecaster has to be a master Fed watcher. They track the Fed speak for clues on the federal funds rate. They study the dot plot for a map of future intentions. And crucially, they watch the Fed's balance sheet like a hawk. They have to ask, is the Fed in scalpel mode trying to guide the market with subtle words? Or are they in sledgehammer mode, actively reshaping the market with quantitative easing or tightening? The answer to that question will determine the entire weather system in which mortgage rates exist. The Fed's actions, both subtle and forceful, are the single most powerful driver in the forecasting equation. They can override almost any other data point. But this raises the most important question of all. The Fed isn't acting in a vacuum. They aren't just raising or lowering rates for the sake of it. They are responding to something. They are fighting a constant battle against two colossal, opposing forces that threaten to tear the economy apart. Understanding what those two forces are, and how the Fed chooses which one to fight at any given time, is the final key to truly predicting their next move. Those two forces are the twin dragons of the modern economy, inflation and unemployment. And their epic battle is where we're going next. These two forces are locked in an eternal zero-sum game, a brutal tug-of-war for the soul of the American economy. And at the center of it all, acting as the reluctant referee, is the Federal Reserve. This isn't just an academic exercise. It's the entire reason the Fed exists. It's called their dual mandate, a directive handed down by Congress itself. It's a deceptively simple mission with two goals. First, to maintain stable prices, and second, to achieve maximum sustainable employment. Think of it this way. The Fed is tasked with keeping two equally dangerous mythological beasts chained up. In one corner, you have the dragon of inflation. This is the beast that makes your dollar worth less tomorrow than it is today. It's the silent thief that creeps into your wallet while you sleep. When inflation is on the loose, the price of everything you buy, from a gallon of milk to a gallon of gas, starts to climb. Your salary, even if it's going up, can't keep pace. The money you've diligently saved for a down payment on a house suddenly isn't enough. The cost of building that house, the lumber, the copper, the labor, all of it skyrockets. Inflation breeds uncertainty. It punishes savers and rewards debtors. It makes it impossible for businesses to plan for the future. And it can, if left unchecked, completely incinerate an economy. It's a corrosive, insidious force. In the other corner, you have the equally terrifying dragon of unemployment. This beast represents economic stagnation and human suffering. When unemployment is rampant, businesses are closing, factories are idle, and families are losing their homes. The fear is palpable. The for sale signs pop up not because people are upgrading, but because they can no longer afford their mortgage. The dream of homeownership becomes a nightmare of foreclosure. High unemployment means a loss of production, a loss of innovation, and most importantly, a loss of hope for millions of people. It's a direct, visceral pain that tears at the fabric of society. Now, here is the cruel cosmic joke of modern economics. The fundamental dilemma the Federal Reserve faces every single day. These two dragons are connected. The chains that hold them are linked. When you pull on one chain to restrain one dragon, you almost always loosen the chain on the other. This is the tragic seesaw of the economy. Historically, when the economy is booming and nearly everyone who wants a job has one, meaning unemployment is very low, people have more money to spend. They're confident. They buy new cars, they renovate their kitchens, they go out to dinner. This high demand for goods and services allows businesses to raise their prices. At the same time, with so few workers available, companies have to compete for them, offering higher wages. To pay for those higher wages, they often have to, you guessed it, raise their prices again. This creates a spiral. Low unemployment tends to unleash the inflation dragon. Conversely, what happens when the Fed wants to fight inflation? They have one primary weapon: raising interest rates. This is the economic equivalent of throwing a bucket of ice water on the economy. It makes it more expensive for businesses to borrow money to expand. It makes it more expensive for you to get a car loan or use your credit card. And crucially, it makes mortgage rates go up, cooling the housing market. As the economy slows down, demand for products and services falls. Businesses stop raising prices. Inflation starts to come down. But what's the cost? As businesses see their sales decline, they stop hiring. Then they start laying people off. In their effort to chain the inflation dragon, they have loosened the chain on the unemployment dragon. This isn't a theory. This is the brutal reality the Fed has lived through time and time again. And there is no more powerful example of this than the story of one man, Paul Volcker. In the late 1970s, the inflation dragon was not just unchained, it was burning the entire country to the ground. Inflation was running at over 13%. People were losing faith in the US dollar. The economic chaos was immense. President Jimmy Carter appointed a new Fed chairman, the towering cigar-chomping Paul Volcker. And Volcker knew he had to make a choice. He had to slay the inflation dragon, and he knew it was going to be bloody. He did the unthinkable. He raised the federal funds rate to a peak of 20% in 1981. 20%. Imagine trying to get a mortgage when the Fed's base rate is 20%. Mortgage rates shot up to over 18%. It was economic warfare. The ice water he threw on the economy was a polar ice cap. And the effect was devastating. The country was plunged into a deep, painful recession. Unemployment soared to over 10%. Businesses failed. Farmers lost their land. The industrial heartland of America was hollowed out. People sent him hate mail. They sent him wooden 2x4s to symbolize the homes they couldn't afford to build. Congress called for his resignation. He was for a time the most hated man in America. But he didn't flinch. He kept rates high. He kept his foot on the throat of the economy until the fever of inflation finally broke. And it worked. By 1983, inflation had fallen from nearly 15% to under 3%. Volcker had slayed the dragon. He had endured the short-term pain of high unemployment to achieve the long-term gain of price stability, setting the stage for 2 decades of economic growth. He made a choice. He prioritized the fight against inflation, knowing full well it would mean unleashing unemployment. Now let's fast forward. Jump to 2008. The world is collapsing. But this time the problem isn't inflation. The dragon-breathing fire is unemployment. The global financial system is vaporizing, Lehman Brothers has failed, and the world is staring into the abyss of a second Great Depression. The unemployment dragon is on a rampage. So what does the Fed, now led by Ben Bernanke, do? They do the exact opposite of Volcker. They see that the primary threat is mass unemployment and economic collapse. Inflation is a distant secondary concern, so they slash interest rates to zero. They pump trillions of dollars into the economy through quantitative easing. They do everything in their power to encourage borrowing, to stimulate demand, to get people hiring again. They chose to fight unemployment, even at the risk of potentially waking the inflation dragon later on. Two different crises, two different dragons, two diametrically opposed responses from the Federal Reserve. This is the dual mandate in action. It's a constant balancing act, a perpetual judgment call. And this brings us to today. After the pandemic, we saw a massive surge in government spending, supply chain disruptions, and a shift in consumer demand. And for the first time in 40 years, the inflation dragon stirred. It woke up, and it woke up angry. The Fed, remembering the ghost of Paul Volcker and the disastrous 1970s, saw this as the primary threat. And so, they began the most aggressive rate hiking cycle in modern history. They were willing to risk a recession. They were willing to see the unemployment rate tick up. They were willing to cause pain in the housing market by jacking up mortgage rates. Because in their judgment, the long-term danger of letting inflation become entrenched was far greater than the short-term pain of a slowing economy. Every single mortgage rate forecast you have seen over the past few years has been, at its core, a bet on how the Fed weighs this epic battle. Is their eye on inflation? Or is it on unemployment? So the Fed is constantly staring at these two monsters, trying to keep both at bay. But how do they know which one is about to break its chains? How do they measure their power before it's too late? They don't guess. They rely on a dashboard of critical data points, a set of economic numbers that act as their eyes and ears on the ground. These are the vital signs of the economy. And understanding those signals, knowing what the Fed is looking at when it makes its world-altering decisions, is the next step to thinking like a forecaster. So let's pull back the curtain on those signals. Think of the economy not as a single entity, but as a living, breathing patient. The Federal Reserve is the doctor, and its job is to keep that patient healthy, not too hot, not too cold. To do that, the doctor needs to check the patient's vital signs. These economic indicators are those vital signs. They are the temperature, the blood pressure, and the heart rate of the American economy. And for the Fed, there are two vitals that matter more than all the others, because they form the very core of its mission, its dual mandate given to it by Congress: stable prices and maximum employment. Let's start with the first one. Stable prices, or as we all know it, inflation. We all feel inflation at the gas pump and the grocery store. It's the silent thief that makes the dollars in your wallet worth a little less tomorrow than they are today. But for the Fed, feeling it isn't enough. They need to measure it with scientific precision. Their primary tool for this is the Consumer Price Index, or the CPI. Imagine a giant theoretical shopping basket. The government fills this basket with thousands of goods and services that the average American household buys. Everything from a gallon of milk and a loaf of bread to a plane ticket, a haircut, and a month's rent. Every month, they send people out to check the prices of everything in that basket. The CPI is simply the change in the total price of that basket over time. If the basket cost $100 last year and it costs $103 this year, you have a 3% inflation rate. But here's where it gets interesting and where you start to think like a professional. The Fed knows that some items in that basket are incredibly volatile. The price of gasoline can swing wildly because of a conflict halfway around the world. The price of lettuce can jump because of a drought in California. These short-term spikes can distort the true underlying trend of inflation. So the Fed pays very close attention to something called core CPI. Core CPI is the same shopping basket, but with two things removed: food and energy. By stripping out these volatile components, the Fed believes it gets a clearer picture of the long-term inflationary pressures bubbling up in the economy. So when you hear news anchors debating the CPI number, the real pros are looking past the headline and digging into the core. But even core CPI isn't the Fed's favorite. Their preferred inflation gauge, the one they officially target, is a lesser-known indicator called the Personal Consumption Expenditures Price Index, or PCE. The difference is subtle but crucial. While the CPI uses a fixed basket of goods, the PCE is more dynamic. It understands that people are smart. If the price of steak goes through the roof, you don't just keep buying steak, you switch to chicken. The PCE index accounts for this substitution, making it, in the Fed's view, a more accurate reflection of our real-world spending habits. The Fed has a very specific target for PCE inflation, 2%. Why not 0? Because a little bit of inflation is actually good for the economy. It encourages people and businesses to spend and invest their money rather than hoard it, which keeps the economic engine humming. But get much higher than 2%, and the alarm bells start ringing at the Fed, signaling that the economy is overheating. And when the economy overheats, the Fed's main tool to cool it down is raising interest rates, which, as we know, sends mortgage rates soaring. That's one half of the mandate. The other half is maximum employment. This is about making sure that everyone who wants a job can find one. The most famous number here is, of course, the unemployment rate. It's the percentage of the labor force that is jobless but actively looking for work. But just like with inflation, the headline number doesn't tell the whole story. A low unemployment rate looks great on the surface, but the Fed knows to look deeper. That's why on the first Friday of every month, at exactly 8:30 a.m. Eastern Time, the entire financial world holds its breath. This is when the Bureau of Labor Statistics releases the monthly jobs report, officially known as the Employment Situation Summary. This report is a bombshell of data, and its headline number is the non-farm payrolls. This is the net number of jobs created or lost in the country in the previous month. It's a direct measure of the economy's momentum. Are businesses confident enough to hire? Are certain sectors like construction or technology booming or busting? A string of strong jobs reports suggests a robust economy. A weak report can signal a coming recession. But inside that report, the Fed is scanning for other clues. They look at the labor force participation rate. This measures the share of the working-age population that is either employed or actively looking for a job. Why does this matter? Because you could have a situation where the unemployment rate is falling, not because people are finding jobs, but because they've become so discouraged they've stopped looking altogether. They drop out of the labor force and poof, they are no longer counted as unemployed. A falling participation rate is a major red flag that the labor market is weaker than the headline unemployment rate suggests. And then there's the number that ties both mandates together: wage growth. The jobs report tells us how much average hourly earnings have increased. On the one hand, we all want a raise. Strong wage growth is good for workers. But if wages grow too quickly, the Fed gets very nervous. They worry about a dreaded wage price spiral. It works like this. Businesses have to pay their workers more, so to protect their profits, they raise the prices of their goods and services. You and I then see these higher prices, so we demand higher wages to keep up. This forces businesses to raise prices again, and the cycle continues, spiraling upwards, entrenching inflation deep into the economy. For the Fed, wage growth that is too hot is a clear and present danger to price stability, and a major reason to keep interest rates high. So, we have inflation and employment, the two pillars. But a good doctor doesn't just check two vital signs. They conduct a full physical. The Fed does the same, looking at a whole dashboard of other indicators to get a complete diagnosis. There's the gross domestic product, or GDP. This is the big one, the ultimate report card for the economy. It's the total market value of all the finished goods and services produced within the country over a specific time period. When you hear that the economy grew by 2%, it means the GDP went up by 2%. It's the broadest measure of economic health. A strong growing GDP means a healthy, expanding economy, which can lead to inflation and higher rates. A shrinking GDP is the opposite. In fact, the technical definition of a recession is 2 consecutive quarters of negative GDP growth. But the economy isn't just about numbers. It's about people. It's about psychology. That's why forecasters obsess over measures of consumer sentiment or consumer confidence. These are surveys that ask people how they feel about their own financial situation and the economy at large. Are they optimistic? Are they worried about losing their job? This matters immensely because our feelings drive our actions. If people are scared, they stop spending money, they save more, and they put off big purchases like cars and homes. This can become a self-fulfilling prophecy, where fear of a recession actually causes one. A sharp drop in consumer confidence is a powerful signal that economic trouble is on the horizon. To see if that fear is translating into action, forecasters look at retail sales data. Since consumer spending accounts for roughly 70% of the entire U.S. economy, this report is a direct pulse check on the American shopper. Are people swiping their credit cards? Are they filling up their online shopping carts? Strong retail sales mean consumers are confident and the economy is chugging along. Weak sales are a sign of a consumer pulling back, which cools the economy and puts downward pressure on interest rates. Finally, for a glimpse into the future, the Fed and forecasters look at forward-looking surveys like the Purchasing Managers Index, or PMI. This is a bit more in the weeds, but it's incredibly powerful. Each month, surveyors ask purchasing managers at hundreds of manufacturing and services companies simple questions. Is your business growing? Are new orders up or down? Are you hiring? The answers are compiled into a single number. A reading above 50 indicates that the sector is expanding. A reading below 50 means it's contracting. Because these managers are on the front lines, making real-time decisions about the future, the PMI can often signal a turn in the economy months before it shows up in the GDP or jobs data. Each of these data points, CPI, PCE, non-farm payrolls, GDP, consumer sentiment, PMI, is a single instrument in a massive orchestra. On its own, one bad note might not mean much, but together, they create a symphony or a cacophony. A forecaster's job is to listen to this economic music and predict what song the Fed will hear. Will they hear a booming anthem that requires them to raise rates to prevent a crescendo of inflation? Or will they hear a slow, somber dirge that requires them to lower rates to breathe life back into the rhythm? These numbers aren't just abstract statistics. They are the language the economy uses to speak. And the Federal Reserve is listening to every single word. The next step is to understand how they translate that language into action. And that translation process happens in a room. A very important room. 8 times a year, 12 individuals gather around a massive mahogany table in the Eccles Building in Washington, D.C. They are the members of the Federal Open Market Committee, or the FOMC. And for 2 days, they become the most powerful economic force on the planet. Think of them less as economists in suits and more as a high-stakes jury. They've been presented with all the evidence we just discussed, the jobs report, the inflation numbers, the consumer spending data. Now they have to deliberate and deliver a verdict. And their verdict, their decision, will ripple through the bank account of nearly every American. Their primary tool, their gavel, is something called the federal funds rate. Now this is a term you hear all the time, but what is it, really? In the simplest terms, it's the interest rate at which big banks lend money to each other overnight. It's the wholesale cost of money. Imagine you own a grocery store. You buy apples from a farmer at a wholesale price. Then you mark them up and sell them to customers at a retail price. The federal funds rate is like the farmer's price for apples. It's the base rate. When the Fed raises that rate, it's like the farmer charging more for his apples. Suddenly, the cost for every bank to do business goes up. And just like your grocery store would have to charge more for apples, the banks have to charge more for their products. And what are their main products? Loans. Car loans, credit cards, and of course mortgages. So inside that room, the debate begins. It's a push and a pull between two opposing mandates given to the Fed by Congress. Maintain stable prices and maximize employment. These two goals are often in direct conflict. It's like trying to drive a car by pressing the gas and the brake at the same time. If the economy is running too hot and inflation is a problem, some members, known as hawks, will argue for hitting the brakes. They'll say, we need to raise interest rates, make borrowing more expensive, cool down demand, and get inflation under control, even if it means slowing down the job market a bit. On the other side of the table, you have the doves. If they see the job market weakening or fear a recession, they'll argue for hitting the gas. They'll say, we need to lower interest rates, make it cheaper to borrow, encourage businesses to invest and hire, and stimulate the economy. The Fed chair, currently Jerome Powell, acts as the judge in this courtroom, guiding the discussion, listening to the arguments from both the hawks and the doves. They look at the data, they debate the risks, and they try to find a consensus. What is the biggest threat right now? Is it inflation running wild, eroding the purchasing power of every dollar you earn? Or is it a potential recession, where millions could lose their jobs? Their decision on where to set that federal funds rate is their official verdict. But here's where it gets fascinating, and where the forecasting game really begins. The Fed doesn't just release their decision. They also release a statement, hold a press conference, and most importantly for forecasters, they release something called the Summary of Economic Projections, which contains the infamous dot plot. The dot plot is one of the most scrutinized documents in all of finance. It's a chart that shows, anonymously, where each of the FOMC members believes the federal funds rate will be at the end of the current year, the next year, and the year after that. It is quite literally a peek inside their heads. It's not a binding promise. It's a forecast from the very people who set the rates. Imagine a jury, after delivering a verdict, also handing the press an anonymous sheet of paper showing how each juror thinks they will vote on the next 3 cases. The stock market, the bond market, everyone goes absolutely wild trying to interpret it. Is the median dot moving higher? That's a hawkish sign. They're signaling they intend to be tougher on inflation. Is it moving lower? That's a dovish sign. They might be preparing to cut rates to support the economy. This dot plot is a powerful piece of forward guidance. The Fed is essentially telling the world, based on what we know today, this is the path we think we're on. Now, here is the most critical link you need to understand. It's a point that confuses so many people. The Federal Reserve does not directly set mortgage rates. Let me repeat that. The Fed does not set your 30-year fixed mortgage rate. The federal funds rate is an overnight rate, a super short-term interest rate. A mortgage is a very long-term loan. So how are they connected? The connection is indirect, and it's all about market expectation. The real benchmark for mortgage rates isn't the Fed funds rate. It's the yield on the 10-year U.S. Treasury bond. Think of it this way. A U.S. Treasury bond is basically a loan you give to the government. You buy a bond and the government promises to pay you back with interest over a set period like 10 years. The interest rate on that bond, its yield, is considered one of the safest long-term investments in the world. So when a lender is deciding what rate to charge you for a 30-year mortgage, which is a much riskier loan than one to the U.S. government, they start with the 10-year Treasury yield and then add a margin on top of it to account for the extra risk. This is called the spread. So, as a general rule, wherever the 10-year Treasury yield goes, mortgage rates follow. And what moves the 10-year Treasury yield? The market's expectation of what the Fed will do in the future and what inflation will look like over the long term. This is where the Fed's words become more powerful than its actions. When the Fed raises the funds rate by 0.25%, that's the action. But when the Fed chair stands at a podium and says, "We will remain vigilant in our fight against inflation," and the dot plot shows rates staying higher for longer than anyone expected, that's the communication. That's the signal. Bond investors hear that signal and react instantly. They think, okay, the Fed is serious. They're going to keep short-term rates high for a long time to crush inflation. This changes their long-term outlook. They start demanding a higher interest rate, a higher yield, to lend their money to the government for 10 years. Why? Because persistent inflation erodes the value of their future returns, and higher short-term rates from the Fed make those short-term investments more attractive by comparison. So to entice investors to lock up their money for a decade, the yield on the 10-year bond has to rise. And as soon as that 10-year yield ticks up, mortgage lenders all across the country get alerts on their terminals. Their cost of capital just went up. The benchmark for their main product just became more expensive. And so they adjust their pricing. Within hours, sometimes minutes of a Fed announcement, the rate you're quoted for a mortgage can change dramatically. It's a direct chain reaction. The economic data informs the Fed's debate. The Fed's debate leads to a decision and, more importantly, a signal about the future. The signal moves the bond market, specifically the 10-year Treasury yield. And the 10-year Treasury yield sets the foundation for the mortgage rate you see online. So when a forecaster is trying to predict where mortgage rates will be in 6 months, they aren't just guessing. They are running a simulation of this entire process. They are playing the role of an FOMC member. They are looking at the same inflation and jobs data. They are trying to predict the tone of the Fed chair's speech. They are trying to guess where those anonymous dots on the dot plot will land. They are, in essence, trying to read the mind of the Federal Reserve to predict the future of the bond market, which in turn will dictate the future of mortgage rates. This is the heart of the forecast, a complex interpretation of a powerful, economy-shaping conversation. But there's another layer to this, because the Fed isn't the only big player moving the scales. There's a whole other side to this equation, a global force that can sometimes override everything the Fed does. That global force is the single greatest driver of long-term interest rates on the planet, the unending, relentless search for safety. Think of the world's economy as a vast, sometimes stormy ocean. When a hurricane of uncertainty brews in one part of the world, a financial crisis in Europe, a major economic slowdown in Asia, a geopolitical conflict, trillions of dollars of capital start looking for a safe harbor. And for the last century, the safest, deepest, and most stable harbor in the entire world has been the United States Treasury bond market. This isn't just about patriotism. It's about cold, hard financial logic. The U.S. government has never ever defaulted on its debt. It has the world's largest economy and controls the world's primary reserve currency, the dollar. So, when big global investors, foreign governments, and central banks get nervous, they don't stuff cash under a mattress. They convert their currency into dollars and buy U.S. Treasury bonds. This massive global river of money flowing into the U.S. is called a flight to safety, and it has a profound and often counterintuitive effect on your mortgage rate. To understand how, we need to grasp one of the most fundamental, yet widely misunderstood, concepts in finance: the inverse relationship between bond prices and bond yields. It sounds complicated, but let's break it down with a simple analogy. Imagine you own a special rare collectible that has a magical quality. It pays you a fixed coupon of $5 every single year forever. You originally bought it for $100. So, your yield, or your annual return on that investment, is $5 divided by $100, which is 5%. Simple enough. Now imagine a wave of panic sweeps the globe. Suddenly, everyone wants a safe, reliable asset. Your magical collectible becomes the hottest item on the market. People start a bidding war to buy it from you. The price gets driven up from $100 to $150 to $200. You finally sell it for $200. Now think about the new owner. They paid $200 for that collectible. But does the collectible care? No. It still only pays out that same fixed $5 a year. So what is the new owner's yield? It's $5 divided by their $200 purchase price. That's just 2.5%. Do you see what happened? As the demand for the safe asset skyrocketed, its price went way up. But because the payout was fixed, its yield went way down. Bond prices and bond yields are a seesaw. When one goes up, the other must come down. This is the iron law of the bond market. Now let's connect this back to your mortgage. As we've discussed, the 30-year fixed mortgage rate doesn't follow the Fed's short-term rate. It dances in lockstep with the yield on the 10-year Treasury bond. So when a crisis happens somewhere else in the world, and global money floods into the safe harbor of U.S. Treasury bonds, what happens? The demand for those bonds skyrockets. The price of those bonds gets bid up. And just like with our magical collectible, the yield on those bonds gets pushed down. And because mortgage rates follow that yield, they get pushed down too. This is the mechanism by which a banking scare in Germany or a factory shutdown in China can actually cause your mortgage rate in Ohio or California to drop. It can completely override what the Federal Reserve is trying to do. There is no better example of this than what former Fed Chair Alan Greenspan famously called the conundrum back in the mid-2000s. Between 2004 and 2006, the Fed was worried about an overheating economy and a housing bubble. So they did what central banks do. They aggressively raised the federal funds rate, hiking it 17 times, from 1% all the way up to over 5%. Their goal was to make borrowing more expensive across the board, cool down the housing market, and slow the economy. But a funny thing happened. As the Fed was furiously jacking up short-term rates, long-term rates, like the 10-year Treasury yield and mortgage rates, barely budged. They stayed stubbornly low. Greenspan was mystified. He called it a conundrum in testimony to Congress. Why was the Fed's traditional tool not working? The answer, in large part, was found across the Pacific Ocean. At the time, China was in the middle of its meteoric economic rise. It was exporting massive amounts of goods to the U.S., and in return it was accumulating enormous piles of U.S. dollars, trillions of them. To manage its own currency and economy, the Chinese central bank took those dollars and recycled them right back into the U.S. by buying staggering quantities of U.S. Treasury bonds. This created a huge artificial demand for our bonds. This immense buying pressure pushed bond prices up and held bond yields, and therefore mortgage rates down, even as the Fed was trying to push them up. It was a global force overwhelming a domestic policy. The Fed was hitting the brakes, but a powerful global current was still pushing the car forward. So, when a forecaster sits down to build their model, they can't just be a U.S. economist. They have to be a geopolitical strategist. They have to ask questions that have nothing to do with American inflation or jobs. How stable is the European banking system? What is the growth target for the Chinese Communist Party this year? And how will they manage their currency to achieve it? Is there an emerging market crisis brewing in South America or Southeast Asia that could trigger a global flight to safety? They're watching the actions of the European Central Bank and the Bank of Japan just as closely as they watch the Fed, because their monetary policies can spill over and influence our rates. They're tracking the trade balances and capital flows between nations. A headline out of Beijing can now have a more immediate impact on the 30-year mortgage rate than a jobs report out of Washington. This global dimension adds an immense layer of complexity and uncertainty to any forecast. It means that even if a forecaster perfectly predicts every single move the Fed will make, and perfectly predicts the path of U.S. inflation and unemployment, they can still get the mortgage rate forecast completely wrong. A sudden, unexpected event halfway around the world can shatter the most carefully constructed model in an afternoon. It's a humbling reminder that the U.S. economy, as powerful as it is, doesn't operate in a vacuum. It's the main character in a global drama, but it isn't the only actor on the stage. So we have the Fed's domestic policy, a complex dance based on inflation and employment. And we have this massive, often unpredictable, global tide of capital that can either amplify the Fed's actions or fight against them completely. You would think that between these two colossal forces, we've covered all the major drivers of mortgage rates. But there's one more critical, and perhaps most volatile, element we haven't touched on yet. It's not about data or economic models. It's about emotion. It's the raw, unpredictable, and powerful force of market psychology. This is the ghost in the machine. It's the part of the equation that can't be neatly plugged into a spreadsheet or a complex algorithm. Because while data tells us what has happened, and economic models try to predict what should happen, market psychology is all about what millions of people feel will happen. And in the world of finance, feeling is often believing, and believing can become a reality. At its core, market psychology is driven by two primal, powerful emotions that have governed human behavior for millennia: fear and greed. These two forces are in a constant tug-of-war, and the bond market, the very place where mortgage rates are born, is their primary battlefield. Let's start with fear. Imagine news breaks of a sudden, unexpected geopolitical conflict, or a major bank halfway across the world shows signs of collapse, or a terrifying new virus begins to spread. What's the instinctive reaction of a global investor holding billions of dollars? It's to run for safety. It's to pull money out of anything that seems risky: stocks, emerging markets, corporate debt, and park it in the safest asset on planet Earth: United States Treasury bonds. This is what's known as a flight to safety. Suddenly, there's a massive surge in demand for these bonds. And just like with any product, when demand skyrockets, the price goes up. But here's the crucial counterintuitive part about bonds. When their price goes up, their yield, the actual return an investor gets, goes down. It's a seesaw. Price up, yield down. And since the 10-year Treasury yield is the primary benchmark for 30-year fixed mortgage rates, that fear-driven stampede into bonds directly pushes mortgage rates lower. Think back to the early days of the 2020 pandemic. The uncertainty was terrifying. The economy was shutting down. The stock market was in free fall. And what happened to mortgage rates? They plummeted to historic lows. That wasn't just the federal. It was also raw, unadulterated fear flooding the global financial system, with investors everywhere screaming, "Get me into US bonds now." Good news for borrowers, but driven by a terrifying global event. Fear can, ironically, be a homebuyer's best friend in the short term. Now let's look at the other side of the coin: greed. Or to put it more politely, optimism. When the economy is roaring, jobs are plentiful, companies are posting record profits, and everyone feels like the good times will never end, the investor mindset flips. Why would you settle for the small, safe, and frankly boring return of a treasury bond when you could be making a fortune in the stock market? Investors, driven by this optimism, start selling their safe haven bonds to free up cash to buy riskier, higher reward assets. This selling pressure floods the market with bonds, causing their prices to drop. And what happens when the bond price seesaw goes down? The yield goes up. As the 10-year Treasury yield climbs, mortgage rates get pulled right up along with it. This is the risk-on environment. Greed and optimism take the wheel, and the cost of borrowing money for a home inevitably rises. So forecasters aren't just looking at inflation data. They are constantly trying to take the emotional temperature of the market. Are investors scared, or are they greedy? This sentiment can shift in a heartbeat, often based on a single headline, making it one of the most volatile inputs in any mortgage rate forecast. But it gets even deeper than just fear and greed. It's about the power of a story. This is what we call the narrative effect. Markets are storytelling machines. A piece of data is just a number until the market wraps a story around it, and the story is what dictates the reaction. Let me give you a perfect example. The monthly jobs report comes out, and it's a blockbuster. Way more jobs were created than anyone expected. Now, on the surface, this is fantastic news for the country. But in the market, this one piece of data can spawn two completely different, competing narratives. Narrative number 1 is the good news is bad news story. In this version, Wall Street looks at the strong jobs number and panics. The story they tell themselves is, the economy is running way too hot. This is going to fuel inflation. The Federal Reserve is going to see this and have no choice but to keep interest rates higher for longer, or even hike them again to cool things down. In this narrative, that great jobs report sends bond traders into a selling frenzy. Bond yields spike and mortgage rates shoot up. But there's narrative number 2, the soft landing story. In this version, the market looks at the exact same strong jobs number and breathes a sigh of relief. The story they tell is, wow, this is amazing. It shows the economy is strong and resilient. It proves we can handle the current level of interest rates without tipping into a recession. This is the best of all worlds. In this narrative, the market celebrates. Maybe bond yields stay flat or even fall a little, because the fear of a recession has faded. So which story wins? That is the multi-trillion-dollar question. Forecasters have to predict not just the number itself, but which narrative will capture the market's imagination on that particular day. It depends on the mood, the headlines from the week before, a speech given by a Fed official the day prior. It's about context, not just content. It's about understanding the psychology of the crowd. This leads us to perhaps the most mind-bending concept of all, reflexivity. This is the idea that the market's expectations don't just predict the future, they can actively create it. It's a feedback loop where belief shapes reality. Think about it in the context of the housing market. Let's say a chorus of influential forecasters all predict that mortgage rates are about to skyrocket over the next 6 months. What does the average person who is thinking of buying a house do? They panic. They rush into the market, desperate to buy a home and lock in a rate right now before it's too late. This sudden, forecast-driven surge in demand pours fuel on the housing market. Home prices get bid up. More people are applying for loans, more construction is needed, more furniture is being bought. This flurry of economic activity can actually start to create the very inflationary pressures that the forecasters were worried about. The Federal Reserve sees this new heat in the economy and says, we need to cool this down. And they raise interest rates, making the original forecast a self-fulfilling prophecy. The belief that rates would rise caused rates to rise. The loop can work in reverse too. If everyone believes rates are destined to fall, potential buyers might sit on the sidelines, waiting for a better deal. This causes housing demand to dry up. Home sales slow, construction stalls, the economy cools, and inflationary pressures ease. This gives the Fed the green light to do what? To cut interest rates, once again making the initial belief a reality. So, how on earth does a forecaster model something as ethereal as a self-fulfilling prophecy? They can't, not perfectly, but they try. They use consumer confidence surveys to gauge public mood. They look at things like the VIX, often called the fear index, to measure investor anxiety. They analyze news headlines using artificial intelligence to quantify positive or negative sentiment. They look at investor positioning data to see if a trade is getting too crowded, like if too many big players are all betting the same way, making the market ripe for a violent reversal if they're wrong. This is the art that complements the science of forecasting. The economic models, the inflation data, the Fed watching, that's the science. It provides the foundation. But understanding the shifting narratives, the waves of fear and greed, and the reflexive loops where belief becomes reality, that is the art. It's what separates a good forecast from a great one. It's the acknowledgement that at the end of the day, markets are not just numbers on a screen. They are the collective and often irrational expression of human hope and fear. We've journeyed through the complex machinery of economic data, the immense power of the Federal Reserve, and the unpredictable currents of human emotion. We've seen how all these forces collide to create a mortgage rate forecast. But this raises the ultimate question. What does this all mean for you? How can you take this intricate, and at times overwhelming knowledge and use it to make the best possible decision for your own future? That's what we're going to break down next. So let's start with the single most important principle you can take away from this entire series. A mortgage rate forecast is not a crystal ball. It is a weather report. A very, very sophisticated weather report, but a weather report nonetheless. It tells you the probability of financial sunshine or economic storms. It gives you the data to pack an umbrella or wear sunglasses. But it does not and cannot control the weather. You do not cancel your entire life because a forecast calls for a 30% chance of rain next Tuesday. Instead, you use that information to prepare. The goal is not to perfectly predict the future. The goal is to make the most resilient and informed decision you can right now with the best information available. For the first-time homebuyer, this is a game changer. You're likely feeling the most pressure, the most anxiety. You see a forecast that says rates might drop half a point in 6 months, and the temptation is overwhelming to wait, to put your life on hold for that magical number. But this is a trap. It's the financial equivalent of waiting for every single traffic light to be green before you leave your driveway. You'll never go anywhere. Your focus shouldn't be on timing the absolute bottom of the market. Your focus should be on affordability and life readiness. Can you comfortably afford the monthly payment on a home you love right now? Does this home fit your life plan for the next 5 to 7 years? If the answers are yes, then the current rate is simply your cost of entry. Remember the old real estate adage: you marry the house but you only date the rate. If rates do fall significantly in the future, as some forecasts might suggest, you have a powerful tool at your disposal: the refinance. You can trade in your old rate for a new, better one, but you can't refinance a house you never bought. Waiting for the perfect rate could mean watching home prices appreciate right out of your budget, completely erasing any benefit a lower rate would have offered. Use forecasts not as a stop sign but as a speedometer. If forecasts are predicting a sharp rise in rates, it might add a sense of urgency. If they predict a slow decline, it might give you a bit more breathing room to negotiate. But the decision to buy is driven by your life, not by a line on a chart. Now, if you're already a homeowner, your relationship with forecasts is entirely different. You're not trying to get into the game. You're trying to improve your position on the board. For you, forecasts are about identifying opportunities to refinance. But again, it's about trends, not triggers. Don't set a calendar alert for the day. A specific economist predicted rates would hit 5.875%. Instead, watch the direction of the trend. Are the underlying indicators, inflation cooling, the Fed signaling a pause, bond yield softening, all starting to point downward? When you see that consensus forming across multiple forecasts, that's your signal to start preparing. Get your documents in order. Check your credit score. Start talking to lenders. The key for you is the break-even point. This is the simple calculation of how long it will take for the monthly savings from your refinance to cover the closing costs. If a forecast makes you believe you can save $200 a month, but the refi costs $4,000 in closing costs, your break-even point is 20 months. If you plan on staying in that home for another 10 years, that's a fantastic financial move. But if you think you might move in a year and a half, a refinance would actually cost you money no matter how great the new rate is. The forecast gets your attention, but your personal timeline makes the final decision. And for the real estate investor, forecasts are a completely different animal. You're playing chess while everyone else is playing checkers. A forecast of rising interest rates, which might cause panic for a first-time buyer, could be a signal of opportunity for you. Why? Because higher rates tend to cool down a hot market. They reduce buyer competition, create more inventory, and can put downward pressure on prices. Your cost of borrowing might go up, but your acquisition cost for the asset itself could go down. You can negotiate harder. You might find deals from sellers who need to get out. Conversely, a forecast of falling rates tells you that competition is about to heat up. More buyers will enter the market, and prices may get bid up. This might signal that it's a good time to sell a property, or that you need to be much more aggressive in your offers if you're trying to buy. For the investor, the mortgage rate forecast isn't just about the cost of money. It's a barometer for market sentiment and competition. It informs your entire strategy, from acquisition to disposition. This brings us to the most crucial part of this entire discussion. We've spent all this time understanding how the experts build their forecasts. Now it's time to build your own. Not a forecast for the 30-year fix, but a forecast for your own life. This is the variable that no economist at the Federal Reserve or analyst on Wall Street can ever plug into their models. First, forecast your income. Where do you see your career in 2 years? 5 years? 10? Are you in a stable field with predictable incremental raises? Or are you a freelancer or business owner with a variable income? Are you anticipating a major promotion? Or perhaps taking time off to raise a family? Your ability to absorb a higher payment, or your need for a lower one, is directly tied to this personal income forecast. An adjustable rate mortgage might be terrifying for someone on a fixed income, but it could be a brilliant strategic tool for a young doctor just finishing their residency who confidently forecasts a massive income jump in 3 years. Second, forecast your timeline. Where will you be living in 5 years? Do you have kids heading to college? Are you planning to downsize for retirement? The length of time you plan to be in a home is the single most important factor in choosing a mortgage product. If your life forecast clearly shows a cross-country move in 4 years for a new job, then you shouldn't be obsessing over the 30-year fixed rate. Your focus should be on a 5-to-1 or 7-to-1 ARM, where you can take advantage of a lower introductory rate for the exact period you know you'll be in the house. Your life timeline dictates your loan timeline. Third, and most importantly, forecast your tolerance for risk. This is your emotional and financial constitution. Are you the kind of person who needs to know with absolute certainty that your principal and interest payment will be the exact same number every single month for the next 30 years? If so, the peace of mind offered by a fixed-rate mortgage is worth paying a premium for, regardless of what any forecast says. Or are you comfortable with calculated risks? Do you understand the caps on an ARM and have the savings to handle a worst-case scenario payment adjustment? Could you sleep at night knowing your rate could go up in exchange for a lower payment today? There is no right or wrong answer here. But being honest with yourself about your own risk profile is more important than the most accurate economic model in the world. So when you see a headline tomorrow, mortgage rates predicted to tumble or experts see rates surging, you'll no longer see it as a command. You'll see it for what it is, a single data point, piece of the puzzle. You now understand the complex machinery behind that headline. You know it's a blend of inflation data, Fed signals, bond market sentiment, and economic modeling. You know its strengths and you know its inherent limitations. The ultimate power comes from laying that external forecast, the expert's best guess about the economy, next to your internal forecast, the deep knowledge of your own life, your career, your family, and your appetite for risk. The sweet spot, the perfect decision, is found where those two maps overlap. It's where the market's possibilities align with your personal certainties. You don't need to outsmart the bond traders or have a better model than the Federal Reserve. You just need to have a better understanding of you. The goal was never to become a perfect predictor of the future. It was to become a better architect of your own. By taking the time to understand this complex world, you've moved from being a passenger, subject to the whims of the market, to being the pilot. The economic weather will still come, the winds will shift, and the turbulence may be unexpected. But you now have the instruments and the knowledge to navigate it with confidence. The future of mortgage rates is a story yet to be written. But by understanding how the predictions are made, you've just been handed the pen to write your own chapter.